Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. It's been yet another week of trade back and forth. Blink, and you might have missed the 50% tariffs the US placed on the EU on the eve of the bank holiday weekend, only to postpone them before said weekend was over. Then, mere hours before we began the show, a US court ruling suggested all US tariffs were illegal. Repercussions from that will no doubt follow in the days ahead. Today, though, we are taking the long view, looking not at 25 days, but 25 years of volatility, courtesy of our big read this week, examining the lessons investors can learn from the first quarter of the 21st century. Julian Hofmann will join us for that later in the show. Before that, though, and after, we will be focusing on company fundamentals. We will kick off by looking at FTSE 250 retailer Pets at Home, which is reshaping its business years on from the pandemic boom that first put it on many investors' radar. Mark Robinson is here to discuss full-year results. And to wrap up, we'll look at BT and ask whether the investment case is starting to change for the long under-pressure telecoms business. I'll be in the hot seat for that one later in the show, examining what we can learn from the company's end-of-year figures published last week. Beginning with Pets at Home, though, Mark, you covered these figures for us. The company, clearly what it does is quite self-explanatory, albeit there are a few more strings to its bow nowadays. What did you make of the results as a whole, first of all?
Well, I think they're generally quite positive on the whole, but there's a clear split that's developed between the retail side of the business and its veterinarian unit as well. With the former, we saw a 23% increase in underlying profits, whereas they shrank in terms of the retail business. The group itself has moved on a little bit in recent years, and beyond ancillary products for pets and the vet service, it also offers services like grooming, insurance, and it also provides advice and workshops for pet owners as well. But I think everyone realizes, or as for me with the narrative during lockdowns, pet ownership increased because of obvious reasons, really. But since then, we've had that prolonged periods of both inflation and then interest rate rises. That's pared back disposable household incomes as well. And that explains to a large degree why the retail business has struggled, because obviously with veterinary services, that isn't discretionary. If your cat or dog is sick, you have to get that seen to. Likewise with the food products, but they can be substituted as well. But a lot of the ancillary accessory products, people aren't really obliged to pick those up as well. So that explains the difference between performance there. But given that one of the main KPIs of the company relates to cash flow, the performance of the higher margin vet business would have been pleasing to management, no doubt.
Yeah, in short, it's the case, isn't it, that it does seem to be the case that people are no longer getting new pets in such great volumes, partly because so many did so during the pandemic, but now the business is very much therefore keyed into looking after the existing pets that people got a few years ago and trying to provide all kinds of services on that front. On which note, the veterinary side of things, I think profit before tax, and that part of the business has now exceeded the retail side for the first time. Cash flow was already higher because, it's quite a high margin business. Two, revenue, though, is still skewed towards the retail side. Let's talk about veterinary services a bit more, because there is this CMA investigation in the background as to the fairness of pricing of those services across the industry as a whole. This is something we've spoken about more in relation to other companies who focus more considerably on the vet side of the business, albeit now Pets at Home is doing so too. This is becoming perhaps a bigger issue for it. The CMA came out the other week with some proposed remedies. It's not finalised yet, but what did they say they might be looking at doing, and will this have any effect on Pets at Home?
Well, it's kind of the the standard things that you'd expect as well. Some better visibility in terms of pricing and treatment options, that sort of thing. Again, that relates to medicines too. So I mean, it's not dissimilar to conventional human medicine in that regard. But there's other things as well. They're looking at restrictions on out of hours contracts too. But saw some research that you sent through earlier as well from Jeffries, I think it was, and said that they don't necessarily see it as a major impediment for pets at home. I guess with any larger organization as well, regulatory change isn't such an issue as it is to individual vets, I would imagine. It's not the only industry to be going through this as well with the CMA. I don't think it's going to have major implications for the investment case.
It does seem to be the initial conclusion. When we've spoken about this before in relation to CVS, the AIM traded vet group, it has seemed to be private equity owned vets that are in the spotlight, or certainly some analysts have suggested that in terms of their fees being somewhat higher, and perhaps they have more to lose on that front, don't they? What about looking at the business more broadly? The capital investment phase it's been through over the last few years, because it has been shifting to some of these other services, and some operational changes as well have required quite a bit of capex. That seems to have been finalized more or less now.
Yeah, they're projecting sort of it's going to return to normalised levels, which is 50 million annually. But in a way, this is why they're concentrating so much on that free cash flow element of the business too. At one point, you could have justifiably described the business as a big box retailer, but over time, they've expanded into more localized formats. They've increased the number of veterinary services they provide as well. But they've also invested heavily in their digital infrastructure and logistics too, which is pretty much in line with every other online retailer. I guess one of the ways you could support margins for the retail section over the long run is to have more and more sales go online, because obviously it's a higher margin option for pets at home there. And who's to say down the track that on a suburban level those centres will deal primarily in the service offering? We don't know that for sure. But there's other areas I mentioned before. I mean, if you're buying, they sell an awful lot of pet food. There's a substitution angle there. They have to compete in price with other retailers in that regard. Although they have it's a strategic advantage in a way that you can just take your pet along to the one centre where you can get all of their needs met. That wouldn't necessarily apply to other parts of the retail world, but with pets, I mean, it's a bit of a traumatic period if your pet was ever poorly for whatever reason as well. But you take it to the one place, you can get all the feed. It's a no fuss option, and you can see why they've invested in the way that they have them.
That makes sense. I think some of the logistics changes are notable too, aren't they? They've got a single distribution centre now fulfilling all their stores, which makes sense. And in some cases, I think their stores, in my own personal case, they've benefited from non-pet owners, because during the pandemic, we were one of those people, me and my partner, we thought we might get a dog. We were in the later stages of doing so. Went to Pets at Home, bought a load of stuff, and then we never got a dog. So they got some revenue from me, and I couldn't return all those things.
It's one step away from the cat cafes they have in Tokyo.
Yeah, that's true. Once upon a time, that could have been an ancillary service, couldn't it, when you used to go into a pet store and see all the animals there. But I think rightly, people have realised that's not the best way to treat them. Alex, what are your thoughts on Pets at Home?
I mean, in very broad brush terms, I think there's clearly a very solid investment case for the company. UK spending on pets has obviously, over the last 5 years increased above GDP. We had this, as we've talked about, this pandemic boom effect. But longer term, it's the sort of category that I think if you were picking and choosing within retail, what's going to grow above trend, pet care and veterinary services, and how, our changing relationship with pets, and how lots of families come to see them as more than just a pet, or how they might have seen them a generation ago, means that this should be a growth area of retail. And building what they refer to as this sort of all-in-one, a true pet care platform makes a lot of sense, as we've discussed. I think on things like pet food and the like, we'd have to assume that's going to be very low margin and potentially loss leading. But the proposition, I suppose, is to bring in pet owners and sort of get the association with the brand as this one-stop shop where they can sell all the higher margin services. The problem has obviously been growth expectations in the last couple of years. The pandemic kind of threw everything out of kilter because we didn't really know what was a sustainable level of growth. And then at the same time, I mean, the CMA investigation is clearly warranted. What's been going on in the pet care sector and the private equity roll up and what that's done to pricing and, potential issues around competition has clearly thrown a bit of a spanner in the works for the investment case. I think, as we also touched on a little earlier, I think there's long been room for optimism with Pets at Home. They've been a big buyer of these independent practices over the last decade too, but the nature of the sort of joint ventures they have with the pet practices means that they should be less forcefully hit by whatever comes out of this, what looks now that's going to come out of the investigation vis-a-vis pricing, because they say that their vet partners have full autonomy over pricing and care. So the concern has been in the industry that the KPIs or the incentive structures for independent, or once independent, now PE-owned vet practices has become quite misaligned, and that's been really harming consumers. So in July, when the CMA is expected to publish some interim conclusions of their investigation, that could be a moment to watch for Pets, because they're hoping this millstone that's really been around their necks for the last year and a half could be lifting. So that sort of setback against the growth, what we understand to be the growth expectations of the company, could soon be lifting. And yeah, we may yet return to the higher rating that Pets at Home was trading on a few years ago, with a note of caution, obviously, about how thin the margins are likely to be on some elements of their retail business.
Yeah, they have said for the rest of this year, or for the next financial year, that they do think retail will continue to struggle. Part of that is a macroeconomic story as well, of course. Talking about the longer term, medium term prospects, though, they did make some changes to their medium term framework, as they call it, in these figures, Mark. What have they said about what they expect in terms of profits, cash flow, revenue looking ahead?
They still expect the veterinary side of the business to contribute the bulk of free cash flow going forward. And I think they've pared back their expectations with regard to retail there. I think you can see it as well, because they've given a fairly broad range in terms of the underlying profits as well, between 150 and 125 million there. So that seems to indicate, or indicates to me anyway, that there's real uncertainty in terms of the retail business going forward. I guess, one of the things you'd want to be looking at would be unit profitability there, whether they have to engage in forms of discounting to get volumes up. But with Alex's point there as well, I was just wondering if that CMA investigation, of the degree to which it's weighed on the share price as well. It's difficult to say like for like, because there isn't another retailer out there which is comparable in a sense. But when you look at the peer average, they're trading well below that at the moment on a very narrow price to book ratio too. They're offering like a forward dividend yield of 5% too. So I mean, we've maintained our buy call on that, but there are some obvious concerns over that retail segment, even though overall free cash flow is set to increase because of the vet arm.
Indeed. Yeah, I was thinking of the sort of the slightly longer term targets too, where they've made some slight tweaks to that strategy, where they say now they expect profits before tax growth there to be ahead of sales growth. Previously, it was quite specific. It was 10% versus 7% sales growth. Consumer sales, this is. Consumer sales forecasts are now mid-single digit, which does speak to some of those retail headwinds. Perhaps a little conservative, to go back to what Alex said, regarding that there's probably some potential for upside there if the CMA issue clears and if that market continues to grow at a fair clip structurally. They are, with the capital investment having subsided somewhat, they are seeing a free cash flow conversion target. They've raised that from 70% of profits to 90%. So I know that's bombarding listeners with figures a bit, but there is some more positive side of things there, and there's certainly the potential for that business to continue to do well in the years to come. We will see what the CMA say in the summer and what the company continues to say in the months ahead. Now, though, we are going to look at our big read this week. It's all about the past 25 years, a period marked by all manner of market pitfalls, shall we say, albeit clearly over that time, investors have done very well as well. Julian, why don't we start by having a quick recap for those who have forgotten or tried to block out of their minds, perhaps, some of the more serious issues of the past 25 years that investors have had to deal with, and then we can get on to what that means and what that might say about volatility in general and what lessons we've learned. But why don't we start by looking at what has actually happened over that period?
Yes, sure. Thank you. Yes, we didn't quite call it a jubilee. I don't think we thought that was in good taste. As we sort of recap in the feature, I looked at a lot of the major market episodes of the past quarter century just to try to put them into context, really. And we had things that, like at the start of the century, you had the dot bust crashing over into 2001-2. Everyone remembers the financial crisis, obviously. That's probably the year zero event for many Western societies. You had things like that strange flash crash in the 2010s. The invasion of Ukraine sparked a lot of market use in 2014, sparked a lot of market volatility. And then there was this changing debate around trade and tariffs throughout that decade and spilling over into this one, which has upended all of our assumptions again about trade and volatility. But so it's been an interesting old time, which I know is kind of seen as a curse in China. But when you really dig into how the market has operated and how volatility, in a funny way, has contracted together over the past 25 years, things have not been as bad, should we say, in inverted commas, as people might imagine it. I mean, doomsaying is a bit of a human nature reaction to these kind of things, but we've actually experienced fewer bear markets during that period than in comparable periods, say in the 70s and 80s, which were much more attritional when it came to share prices. I mean, I think everyone remembers, at least I can remember, the 87 crash in New York in October, Black Monday, and that lost a fifth of the value of the market in a day. I mean, that's still a record for the New York Stock Exchange. So in some ways, we've experienced a market that is significantly more unpredictable, but at the same time, there seems to have been an underlying basis to it. Yeah, that's what we go into in more depth in the article. It's been, as you said, we probably won't be cracking open the champagne at this point, but it hasn't been the worst of all possible worlds. Maybe that's the best way to describe it.
And certainly people have made quite considerable gains over that period. I mean, clearly it's a long period of time. There's nothing to suggest it's been a bad period for the market overall. In some ways, I mean, there are some interesting points we get into in the article we might not now about the difference between economic stability and market downturns, and the difference between volatility and sometimes big drawdowns, because there is some suggestion, if you look at something like the VIX index, it's been relatively elevated at times without huge drawdowns coming through. So there's been a lot of nerves, perhaps. At the same time, these drawdowns, when they have happened, there's been a very quick recovery in a lot of cases, and sometimes they haven't really manifested at all.
No, that's true. I mean, we've seen all sorts of phenomena, but probably one of the most important is that there has been a definite concentration of both risk and volatility over that time. I did a market comparison between 2025 and the mid-90s, and there are half the number of companies on the US market, let alone there's a whole debate about how the FTSE has shrunk over the same period. The effect of that, according to reputable research into the subject, is that you tend then to concentrate all your risk and volatility into a very small number of assets. The consequence of that is this kind of under and overreaction to news that we see all the time. So traders have been doing quite well out of that type of volatility. But if you just sat on it without moving your shares or reacting too much yourself, you would come out at the end with a very good gain. It's something to do with human behavior as well, but the contrast between our economic circumstances on the one hand and how the market performed has not mirrored each other. There's definitely been a shortening of the business cycle to about 5 years, say. So every 5 years there seems to be a volatility event, but that hasn't manifested itself in necessarily a massive decline either in the market or in the underlying economy. So the number of bear markets that we've experienced is far less than prior generations. So that's definitely a positive, I think, to come out of that.
Notwithstanding that, there's some interesting research you mentioned in the piece about, academic research looking at, you alluded to a point just now, market efficiency and how efficient people are and investors are at pricing things in. And there was some interesting conclusions drawn by one piece of research.
Yeah, that's right. So, nobody is particularly efficient at it. And this goes for professional investors as well as retail investors, that people tend to behave in very much the same way. So the market tends towards heightened volatility, and this may be exacerbated by things like meme stocks or the much easier ability to trade these days. You can just do it through a phone on an app, whereas in the 90s you had to write a letter to your broker if you wanted to buy some shares or sell some shares at some point. We've got this combination of concentration coming through, people's kind of natural reactions to things, and the ability then to act on those impulses, which is quite noticeable in the research that we cited. It can be, well, it's quite astounding, really, that even like micro decisions on an individual level, they get amplified through the system very, very quickly, and very, like, someone's decision can be, sale or buy decision can multiply by several percentage points once you get it right through, once it goes straight through the system. So yes, it's almost like that, the Gaia theory of everything. It's a butterfly claps its wings and then there's a tornado somewhere else in the world. That's very much apparent in the modern market these days, whereas perhaps in more settled periods, like say the mid-90s, volatility was reflected the fact that economic conditions were more benign, but that might have been because there was a behavioral difference in the way that people reacted to it.
And what are some of the things we can learn and take from all this? There are some examples you mentioned in the feature, and also some reader lessons that one particular reader has concluded from this period too.
Yes, I think there's some interesting stuff that we picked up. I mean, obviously, our readership has a lot of nous when it comes to reading the markets. I mean, some of the things that I picked up on were that the way that we regard high growth, high price shares has to be sort of perhaps reevaluated. What we understand as risk is perhaps that there may be a problem with it, but there's also the ability to get a huge payout from buying a high value share, for example. That came across in research that people did into the Nifty 50, for example, which was the kind of 1970s, 80s equivalent of the Magnificent Seven. And not all of those did very well, but if you had picked out one or two individual shares that had high compound annual growth, you would have ended up at the end of the 2000s with a massive payout. If you had held all those shares until the end of the 2000s, you would be poorer than someone who had just tracked the S&P 500. So that's quite an interesting contrast in risk there. And I spoke to an IC reader about his experiences of the past 25 years, and I've known Chris, he's called for a very long time. We used to do Gilbert and Sullivan together back in the day, but his take on it was quite pithy in a way, because he decided that he was essentially a buy and hold investor, and he would keep his faith in the market over the long term, and that by keeping his teeth gritted, as he said, that he would keep his money in the market and allow the compounding effect of that to take hold. And he seems to have done very well out of it. There are just lots of standard good points that he makes. And you shouldn't ever fall in love with a stock. Be prepared to cut your losses when it's clear that things aren't going well. Obviously, read the Investor's Chronicle for progress checking, which he says is invaluable. That is definitely words that we can all live by.
Absolutely, yeah. If any of our listeners have their own lessons from some or all of the past 25 years, we do encourage you to get in touch with us. The email address lessons25@ft.com, and we'll be interested to see what listeners and readers say about their own experiences. We're going to wrap up now, though, with BT. The telecoms company reported full-year results the end of last week. Mark, you covered those, and you had some thoughts and queries on the company itself, I believe.
Yes. If I'm going to be perfectly honest, I've found it very challenging valuing telecoms companies down through the years. There's a combination there of a fairly complicated backstory in most cases, along with major technological developments, varying degrees of capex. Then it's not an easy sector to get your head around. At least certainly that's the case with me. But you had a look at the results, and I guess the headline figures there is that even though we saw there was a slight decline in revenues, when you look at the gross margin, cash profits, and normalised free cash flow were on the rise, which is most pleasing where investors are concerned. Looking at it, what's your take on it? How do you think this might have been achieved?
Well, there's a few things here, aren't there, with BT, and you can see with the share price in the past few months has started to take off after a really bad period. Part of that is to do with the belief that this cash flow is starting to come through. It's partly to do with the fact that this big capex investment BT has made, building out full fibre broadband via Openreach across vast swathes of the country. It's been plugging huge amounts of money into that for years now. That's starting to, if not come to an end, then bear fruit, certainly the company would say. And on the other hand, the new chief executive, Alison Kirkby, has really overseen a big cost-cutting period as well. There's been lots of headlines about them getting rid of jobs and looking to manage costs quite tightly. So with BT, you do have to, with telecoms in general, you do have to be wary of the fact that a lot of these figures are adjusted. Normalised free cash flow is slightly different from free cash flow, which we'll come to later on perhaps. Likewise, adjusted Ebitda was a little bit up. Actual Ebitda is slightly lower, and there are a few one-offs in there as well, and obviously higher costs the company's dealing with, notwithstanding its controlling efforts in terms of higher wage bills, that kind of thing. But the overall narrative, and I think what people are starting to get a little bit more interested in, is that cash flow, certainly in the normalised fashion, is starting to improve, both because of the savings it's made and also because that capital expenditure is starting to fall. And actually you can see some of the money coming through from certainly things like the broadband business as well.
I think that point about the cash profits measure as well just underlines the challenges there are from a valuation perspective, I think, because you look at a company like BT and it can change in a space of about 18 months. It can have significant change during that period. And I guess that's what's going on at the moment, particularly with regard to its open reach services there. In the article, we point to the fact that there's greater strategic clarity. I think that's a subjective view of it. But where is this borne out? Because I mean, the company's technological capabilities are expanding, but by the same token, it's become more focused on its core domestic market. Well, what's happened there, and what's the thinking behind it?
That basically sums it up, doesn't it? It's looking much more at the UK to an extent, like Vodafone has been with selling off its businesses elsewhere, or some of those businesses. BT, there is talk of hiving off the international business. It's being grouped together, potentially prepped for sale or some of that business. There's the 50% stake in TNT Sports, which there was some thinking that there might be an announcement about a sale of that to Warner Brothers Discovery with these results. That hasn't happened yet, but may well happen soon. So it's very much hunkering down, focusing on the UK, because given the open reach build out, that is where the big prize is in terms of getting people onto these full fat broadband, much faster broadband services. There are a lot of issues there, which we might come to in a minute, but that, I think, is the strategy, getting to be a leaner business focused not entirely, but more specifically on the UK and the potential growth that could come from that now that the open reach build out is really starting to pay off.
Yeah, the technological development as well, it comes with a fairly hefty price tag, and BT isn't the only telecoms group that's been criticise or face investor anxieties really over the levels of capex. You've got Verizon and AT&T in the past have also come under criticism at various points down the line there. You need a significant amount of capital to expand and update networks and fund 5G rollouts, things of that nature. Do you think that as a risk factor there isn't, or the threat that poses to margins and earnings isn't readily appreciated by investors, or do you think that's been reflected in share prices for a lot of these telecom groups?
I think it certainly hasn't been appreciated, or the extent to which that spend would be required and how much spend would be required hasn't been appreciated over the years. And that's part of the reason why share prices have done badly, is because this capex has gone on, and certainly, for example, during the pandemic, inflation added a lot to the amount that BT was having to spend as well, to take that specific example. But I think the story is starting to change now, certainly for BT itself. It's moving on, in my view, from a question of how much capex there is to a question of what is actually happening in the UK with Openreach, with its broadband services and take up of those, and the competition there in particular. I mean, you look at these figures, their build out of those services is going quite well. They're making a record number of connections. They say the take up rate is improving and is what they say is at an industry high, which is 36%, I think it was, which doesn't sound that high, but that's of the connections they're building around the place. How many people say, okay, we will take up this service, we will use this service from you, and that's consumers as well as business customers. The concern, though, has been that the number of customers it's nonetheless losing in the Openreach broadband division has started to tick up again a little bit, certainly in the fourth quarter. That was more borne out from business customers, wholesale customers, than consumer. I think consumer is back in positive territory. But this all speaks to the concern that a lot of analysts have about competition, really, in the market. We know, and I'm sure most listeners will know, perhaps from getting flyers through the door or perhaps from using these services themselves, there's big competition in broadband still in the UK from the so-called altnets, these startups in many cases who are offering faster services. In some cases, they're offering services to people who won't yet get the BT superfast broadband, and they say, we can provide this to you much quicker, and we can do it right now and for a good price. And in the past few months, actually, maybe partly because the shares have gone up a bit as well, there have been several analyst downgrades of BT, mostly on the basis that they're worried about this competition in the UK from a lot of these altnets. I mean, some of them don't have the biggest pockets, but there's a lot of them, and they could merge together, for example, and they are making inroads in certain parts of the country. There's also a concern in mobile as well. I think now you have Vodafone and Three, the UK merger there, making a stronger competitor. So I think what people are really going to be looking for in the quarters ahead with BT is how much progress it's made, not just making the connections with Openreach, not just building those out, but also in terms of how many people are using them, how many broadband customers it's adding or losing quarter on quarter, and that could really define, I think, its prospects for the next few months and quarters.
So lastly, we just have a quick look at the valuation there, and despite some negative sentiment in the market, the shares are up by about a third over the last 12 months or so. The forward yields over 6% at the moment. The enterprise Ebitda ratio stands at 4.5 times, and with a fairly lowly priced book multiple as well. But does this just point to the fragility of sentiment, or do we see this as a buying opportunity?
I think we've had BT on a buy for some time. Arthur Sants, our colleague who normally covers them, has been talking about that cash flow coming through, and it has started to improve, and you've seen some of that in the share price. But it's fair enough to say, isn't it, that there are still a lot of doubts over the medium term about what the company is capable of delivering, and some of those metrics do reflect that uncertainty. I think, yes, you've also got to consider when you think of things like free cash flow and some of these metrics, how the pension fund, the pension deficit affects things. That's clearly been a bit of a millstone for BT for some time now. Its normalised free cash flow doesn't include pension payments. So when you factor those in, the dividend, I don't think it's necessarily at great risk right now, but it's not as well covered as it might otherwise seem. The pension fund, I mean, clearly gilt yields have been going up. That helps reduce the deficit and it helps improve the funding situation, but BT is still making payments into that pension fund every year as well, which could change depending on how market circumstances, gilt yields change as well. So that's something investors need to keep in mind, and also still part of the reason why there is uncertainty around the business. But bigger picture, they have got through this big CapEx spend, as I said. It is now about whether they can deliver operationally. I think whether people like their services, whether wholesale consumer customers continue to sign up to these fast services, which are considerably faster than the standard broadband connection in the country. So there is a benefit to doing so, which I think a lot of people will find, whoever they use for the full fibre services. So there's pluses and minuses as ever. I think, in short, there are lots of uncertainties. The shares have come on a fair way over the past few months, but things are a little brighter than they were certainly a couple of years ago. On which note, we have reached the end of the show. Unfortunately, we've run out of time, but thank you very much to you, Mark. Thank you to you, Julian, and to you, Alex, as well, and our producer, Maddie Apthorpe. We will be back next week